This content should not be construed as financial or investment advice. I am simply sharing my personal views and perspectives, which I hope will educate and inform, help give you the confidence to make your own financial decisions. If you need financial investment advice, please seek in-person advice from a qualified, experienced, and regulated finance professional. YouTube will not save you. So, okay, I wanted to check out this video by Coin Bureau, and this is a really good channel which I follow and subscribe to, which covers all things crypto. But today they're actually talking about something called private credit, which I thought is a bit of a departure from what they normally do, which is why it piqued my interest. Now, if you're not sure what private credit is, essentially it's typically something that billionaires in the past used to do, where they would loan money to companies, essentially. And that's what basically made it private credit. So private credit basically is just essentially, in a very simple terms, a loan that has not come from a bank or a normal lending institution. So if I was to lend you money for whatever purposes, that could be considered a form of private credit. And the distinction between private credit and private equity, which is something we do talk about on this channel and on many finance channels, is that private equity is a form of investment from, say, a private individual rather than a bank. So if you get angel investment, for example, and you may have seen something like this on Dragon's Den, which is a program that's quite popular in the UK, that will be a form of private equity investment. So if these are things that you want to understand in terms of how they apply to your own business, if your business is seeking financing or investment, please feel free to reach out and we can talk through that in more detail. But that's essentially what we're talking about here. And the implication of this particular video we're looking at by Coin Bureau is that there is a potential, or there is a theory that there's a potential private credit bubble. And what is the potential impact on the wider economy and to us as retail investors with respect to this private credit bubble. So as I say, let's get involved, let's dive into this video and see what we can learn.
The dark days of the great financial crisis are safely behind us. The system is fundamentally stronger than it was back then, and the reckless lending practices of the past are no more.
Yeah, and it's funny because I think he's being sarcastic, because the reality is, the question is, have we learned the lessons from the financial crash in 2008? And this was the financial crash relating to the housing bubble, essentially. And these were instruments called collateral debt obligations. And one of the things actually that the UK proposed was trying to create a segregation or a distinction between institutional banking and retail banking as a way of safeguarding retail investors and allowing investment banks to fail if needed, so that they didn't need to be bailed out in situations where there's a financial crash. Now, from what I understand, that segregation of these two activities, investment and institutional banking versus retail banking, never happened. And I'm not sure what was actually learned coming to this guy's comments here around lessons learned and protecting consumers going forward. So as I say, I think he's just sort of given us a bit of a tongue-in-cheek view on this, and he's actually being sarcastic and alluding to the fact, in my opinion, that we didn't actually learn anything and nothing fundamentally has changed from a governance and protective framework position.
Well, no, not exactly. In the more shadowy corners of Wall Street, major banking institutions are loading up the exact same financial weapons that were used to bet against the housing market in 2008. This time, however, they are not targeting subprime mortgages, but rather a $3 trillion shadow banking system where default rates have already surpassed the peak levels recorded in 2008.
Yeah, so default rates, which he's referring to there, is basically the rate in which people fail to pay back any credit that has been extended to them. So if you receive a loan and you can't keep up with the payments, that would be considered a default. And what he's essentially saying is that the rate of defaults has exceeded what we saw prior to the financial crash in 2008 with respect to the housing bubble. So that's essentially what he's talking about here. And when he talks about this shadow financing, the reason he's referring to it as shadow financing and private credit by extension as shadow financing is because it wouldn't be subject to the normal regulations as if that finance had come from the bank. So with a bank, for example, they may have to consider affordability criteria, they will have to do some due diligence, and they will have to create an audit trail that they can then show to the regulator, and in the UK, that'll be the Financial Conduct Authority, to show that they are lending responsibly. Now, with the case of private equity, although the individuals involved will be very experienced and very sophisticated, as I say, this will be billionaires, high net worth individuals, and private equity funds, essentially, where they may do the lending and the buying and the investment. And again, there are conflicts around that. What it doesn't mean, the concern and the risk is that the phrasing shadows mean is that there's no clarity, there's no transparency, there's no oversight and from a regulatory point of view, and therefore there's increased risk. So this is why he's making or using the term, this sort of shadowed form of financing. Essentially, it's because there isn't this same clarity and this same regulation that we would see through conventional lending.
Today, we reveal why a massive shorting machine built specifically for the private credit market is flashing a warning sign for the global economy.
And when he says this shorting, when he talks about shorting, what he's saying essentially is that people are betting against this bubble, and they're anticipating that there will be a crash in relation to private credit. So there's going to be massive defaults that basically reduce the value of any loans, private credit loans, essentially. So any private credit instruments you may have, and these will be assets sitting on the lender's books, they're going to diminish in value quite significantly. And therefore, anybody shorting or placing a bet that anticipates that drop in value in terms of these loans that are sitting on the balance sheet will make a massive gain, in the same way that those that in the film The Big Short bet against the housing market saw massive gains, because again they anticipated that many of these collateralized debt obligations would lose a significant amount of value because people were defaulting.
Following the 2008 financial crisis, sweeping regulatory reforms fundamentally reshaped the architecture of corporate lending in the United States and across the developed world. The Dodd-Frank Act and Basel III capital requirements dramatically increased the cost for traditional banks to hold leveraged corporate loans on their balance sheet.
So Basel III, which we saw there, basically talks about how much collateral a bank must have in order to lend. So what he may be talking about here, and I'm not sure, is that if you raise the amount of cash a bank has to hold in order then to lend, it makes lending more expensive for the bank, and they have to lend in a more conservative way. So in that context, private credit will be more attractive and potentially more profitable, even though it's riskier, essentially, because it will be cheaper. You won't have this need to have as much collateral, because then potentially they're not subject to this Basel III regulation. So it comes back to what I'm saying about the fact that private credit may be the thing that is exploding now, because conventional lending is not seen as profitable as private credit, because of this increased regulation and this need to have more collateral and basically more money in your bank. The bank has to hold more money before it can lend out. So essentially what it would mean is, previously maybe they could lend £8 for every £1 they had. But then these Basel rules may require that actually they can only lend £5 for every £1 they're holding in the bank.
This regulatory retreat created a vacuum at the very base of the corporate financing pyramid. And that vacuum was rapidly filled by asset managers and private equity firms operating entirely outside of the regulated banking sector.
Exactly. So that's exactly what he's saying here. So because these changes meant that lending to certain clients or certain businesses became unprofitable and economically unviable, there's still a lending need. And therefore, that's where private credit has now stepped in, albeit private credit is less regulated. So the regulation in itself hasn't actually solved the problem, ironically. If anything, what it's done is that it's opened up even riskier lending. And that's the irony of what's happened here.
These private lenders began issuing trillions and trillions of dollars in loans directly to mid-sized companies, bypassing the traditional banking system and all of the transparency requirements that come with it. The industry that emerged from this regulatory gap is known as private credit. And it has exploded from a $40 billion niche in the year 2000 to approximately $3 trillion as of early 2025.
And that's a massive increase in 5 years. But the term private credit isn't a new industry, as I say. It's just becoming more prominent in our minds because of this explosion he just demonstrated on the screen. Essentially, private credit, as I've mentioned before, is any form of private financing, essentially private loans that technically could be viewed as private credit. So as I say, private credit has always existed. It's just not something that has been it was not something that was happening as much as it is now. And partly is because banks were able to offer lending because regulatory requirements were not so rigid, essentially. But now that they have become tougher, now that they've become rigid, there's still a lending demand and a requirement to supply that demand. So therefore, that is where private credit has come into play. And it's the same with any kind of lending, actually, and which is why we've seen an increase in lending on credit cards, payday lenders, because and pawn shops, because the government and regulator can say, look, you know what, banks, you cannot lend to these individuals for whatever reason. Maybe they don't meet the affordability criteria. Again, it may become economically unviable for the bank because they've got to hold a lot more collateral. But but the person that has applied for the loan still needs the loan, right? So therefore, it just creates, a gap in the market for somebody else to fill. And that's essentially what's happened here ultimately.
This growth represents a systemic danger. You have to look at the specific structural characteristics that define these loans. Because these lending arrangements are entirely private, they lack the standardized credit rating systems.
And that's really important. They are private and they lack standardization regarding credit rating systems. So as I say, although these people will be sophisticated and they will do their due diligence, it's not standardized. Some will be better than others. And also there may be, it may not be objective, it may not be impartial because it's not standardized. And that's where the risk comes in. So this point is raising is really important.
Mark-to-market price discovery and the secondary market liquidity that exist in the public corporate bond market.
Yeah, and again, he talks about secondary liquidity. So again, this is just something where the actual loan itself may be underwritten by another product, i.e., if, for example, there's a default on the loan, there's less exposure to the lender, essentially, because there's a secondary liquidity market, i.e., there's a secondary source of cash. So again, this may be absent from any private credit arrangement.
To put it simply, these loans are valued using internal models built by the exact same fund managers who originated the loans and who collect management fees based on the total value of their assets under management.
Exactly. So that's the other point here as well. Potential conflicts. Now, if you go to a bank and you borrow from the bank, then there isn't this conflict because all they care about is your ability to repay the loan. Whilst if we're looking at a private equity fund, for example, or a venture capital fund, there is a clear conflict because essentially in the case of so the main reason or one of the main reasons why these private credit arrangements may happen is to fund a business buyout. And this could be a leveraged buyout, for example, where the business itself is used as collateral. So in an ideal world, you want the business to have as high a valuation as possible in order to borrow on the most favorable terms as possible. And this comes back to a point I've made in previous videos around the fact that you don't have to sell assets to monetize an asset and gain a financial advantage from those assets, which is why the idea that, people's wealth on paper is not real wealth is a bit of a fallacy, right? This is a classic example whereby if you can demonstrate or argue that your business has a much higher valuation, you can therefore get favorable terms with respect to private credit. Now, if the person arranging this private credit is the same people that is looking to acquire the business, then there's a clear conflict, essentially, which, if you borrow from the bank, that is not the case. So it's a bit like basically saying, I want to buy a house. I'm going to use that house as collateral for my mortgage, which is something you would do, but you are the person that basically dictates the value of the house, and therefore you can influence your mortgage terms. That's kind of a roundabout way of seeing this, right? Clearly, that is not the scenario in which, if you are going to buy your house through a mortgage product, that it would happen, right? That is not how it would work. And that is why private credit can be seen as quite opaque, quite shady, as you mentioned before, and why there could be a conflict between the acquirer of the business and the lending arrangements that allow that acquisition to happen.
You see, when the entity responsible for assigning a value to an asset is the same entity that profits from that value being high, you have created a structural incentive to overstate the health of the portfolio. As of the first quarter 2025, direct lending loans were still being marked at 98.7% of their original face value, despite surging defaults and collapsing profitability metrics.
Yeah, so basically what he's saying there in a roundabout way is that the value of the loans, so on the lender's books, right? So this is the private creditor's books, for want of a better word. They will have on their balance sheet private credit assets akin to these collateral debt obligations that we talked about with respect to the housing market. And what he's basically saying there is that despite the increase in default rates, i.e., people failing to pay back the credit that's been extended to them, we're still valuing these assets, these lending products, these private credit lending products at 98% of their original value, right? So what he's arguing essentially is that because there is this conflict between, the person looking to obtain private credit and the need to value the business as highly as possible, they are basically overstating the value of these private credit products. Right? That's essentially what he's arguing here because of this conflict.
Furthermore, Bank of America strategists have explicitly characterized this entire asset class as the lowest quality segment within the leveraged finance sector.
Yeah, the lowest quality segment. So I think that tells you what you need to know about private credit. So again, coming back to collateral debt obligations, they would have been rated as AAA, i.e. high quality. And what I think it is JP Morgan he mentioned there is that they're saying it's the lowest quality, right? So, make of that what you will.
This is the shadow banking system operating at a massive scale with virtually no external oversight. And it is precisely the kind of opaque, interconnected financial architecture that regulators failed to monitor before the last crisis.
Yeah, and I think what's odd about all of this is that arguably the government would know about this, right? Or they should know about this, and it's been happening for the last 15 years, according to this individual here. So why hasn't regulation caught up, actually, would be my question.
Now, you might assume that even if this lending sector carries elevated risk, the borrowing companies themselves would simply adjust their business models to manage the additional debt burden. However, that assumption completely ignores the specific financial engineering embedded into the structure of these loans, because the entire private credit boom was constructed on a foundation of floating interest rates during an era of effectively 0% monetary policy. Unlike traditional fixed-rate corporate bonds, where the interest payment remains constant for the life of the instrument, the vast majority of private credit loans carry floating rates tied directly to the Federal Reserve's benchmark through a reference rate known as SOFR. This means that every single basis point increase in central bank policy rates flows directly and immediately into the debt servicing costs of these mid-sized corporate borrowers. For a typical mid-market borrower with a private credit loan priced at SOFR plus 550 basis points, the all-in interest rate exploded from approximately 5.5% in 2021 to nearly 10.8% at the peak of the hiking cycle.
Yeah, so I'm not sure what SOFR is, if I'm being honest with you. He's referring to a base rate there with respect to SOFR, that acronym. And I'm thinking of something in the UK where we may have the Bank of England rate, or the rate in which banks borrow from each other, or from the Bank of England. But many private equity lending or crediting will track the base rate and have a margin. And that's what this graph looks like to me here, where it might be there's a 5% margin on the actual borrowing. So basically, if the base rate or this SOFR rate increases by 1%, then instead of this credit interest rate being at, say, 5.5%, it will increase to 6.5%, essentially. So as the base rate increases, the interest rate for any private credit products for the lendee will become more and more expensive. So if all of this was based at a time where interest rates were next to zero, then obviously now that interest rates are increasing, and to combat inflation, these products are going to become increasingly more expensive for the lendee, and therefore default rates will increase, and therefore the value of these private credit products should be depreciated on the balance sheet accordingly. That's what should happen. But what he's actually saying is that despite what we're seeing here with this increasing expensiveness of these products, the actual private credit product on the balance sheet of the lender is still remaining at 98% of value, which on the face of it is questionable. It doesn't make a lot of sense.
For a company carrying $100 million in outstanding debt, this represents the difference between $5.5 million and nearly $11 million in annual interest expense, effectively doubling the cost of capital in a matter of months. The devastating consequence of this rate shock is visible in the collapse of interest coverage ratios across the entire private credit borrower universe. The average interest coverage ratio, which measures a company's ability to pay its interest obligations from operating income, has plummeted from 3.2 times in 2021 to approximately 1.5 times as of recent months.
Yeah, and that's another example of showing actually when you take this into account, should the value of that business be reduced, right? That's essentially the implication here. Because if the business is not growing as a result, since receiving this private credit borrowing, then obviously the proportion of their debt relative to their incomings will increase, right? It will be adverse in the same way if their assets are not increasing, because again, revenues are broadly the same. So what I mean by their assets here is that, if, for example, the amount of money they're expecting from their clients, or the amount of assets they have in terms of capital, so this might be things like buildings or, computer equipment, again, they've not got the money to increase these things, or acquire more of these things. So the business is fundamentally the same, but interest rates have increased. The implication is that that business is more risky, essentially, and its ability to pay back any private credit lending facility is diminished somewhat. And again, that should be reflected in the books of the private creditor lender, essentially. So again, what he's the narrative he's building here is that there is a potential bubble because we're overstating the value of private credit debt, and people are anticipating this and betting on this basis, essentially, i.e., they're shorting the private credit market.
And the International Monetary Fund recently reported that 40% of private credit borrowers had negative fee operating cash flow at the start of 2026.
Yeah, so when it says negative free operating cash flow, it basically means they're hemorrhaging money, right? It just means that month on month, they're losing money, and eventually they will run out of money.
These companies cannot generate enough cash from their operations to cover even the interest payments on their outstanding obligations. This creates a situation where companies that were highly profitable under zero-rate conditions are now suffocating under compounding interest expenses that their revenue models were never designed to sustain.
Yeah, and this comes back to the conflict, right? So if the acquisition, so again, what I mentioned earlier is that one of the reasons why private credit may happen is that it enables a buyout. So it might be a management buyout where the management team chooses to buy the company from the owner, or it could be a leverage buyout where the business itself is used as collateral to obtain private credit borrowing, right? And as I say, there's this incentive or conflict that means that you want to show the business as being more valuable or as valuable as possible. In the same way, if you're going to sell your house or you're going to renegotiate your mortgage, then again, you're going to want to argue your house. You want to make sure you agree a valuation for your home, which is as high as possible, right? That's essentially what's going on here. So again, if you then, on that basis, extend yourself, so you get a massive amount of private credit borrowing, right? You get a massive private credit loan, and your repayment schedule is based on, this very low historic rate. But you've also agreed that basically, as and when those rates increase, the amount you have to repay also increase. What you're essentially relying on is that as that happens, your business continues to grow. It continues to scale. It continues to increase in its revenues. It increases the amount of assets it has and accumulates as a result of increasing revenues, and therefore is in a position to keep repaying this increasing private credit debt. And what you also have to consider as well is that typically these arrangements may include what we call a balloon payment. So this will be a massive, large payment at the end of the borrowing terms, similar to if you are borrowing money or you're buying a car on finance. You will put down a deposit, you will have monthly payments, and then you'll have the option at the end to acquire the car. But then that will require basically another large amount of money, which would be viewed in the context of this discussion we're having as a balloon payment. So basically what he's saying is that, but in this act of buying out the business through something like private credit, the person buying it has not actually been able to increase the value of the business and or increase revenues sufficiently to cover this increasing private credit interest payment burden. And therefore they're running out of cash. That's essentially what he's describing here.
And the most alarming indicator of this suffocation is the explosive growth of what the industry calls payment-in-kind lending, where borrowers who cannot afford to make cash interest payments instead capitalize that interest directly onto their principal balance, effectively paying debt with more debt. The share of these distress-driven amendments surged to 57.2% of all payment-in-kind activity by the third quarter of 2025. Compared to just 36.7% in 2021, confirming that the majority of this zombie lending is now driven by genuine financial distress rather than structural planning. Okay, here is where the direct parallel to 2008 becomes impossible to dismiss. The major institutions on Wall Street are not ignoring this deterioration in the private credit market, and they are certainly not waiting for it to resolve itself. They are instead actively building the infrastructure to profit from the collapse.
Yeah, and again, it comes back to what we were saying before, actually. If Wall Street are now anticipating this and are placing trades, apparently, allegedly, or bets on this basis, it hasn't technically happened yet. So the government could, or the regulator could, step in, right? But why does the crash or the potential crash have to happen, and then we reactively do the regulation? That to me is what seems a bit strange here. But anyway, so I hope you're enjoying the video, and please feel free to leave a comment, because it's always good to hear different perspectives on the topics we talk about here, and it's the way we learn. Otherwise, if you are new to the channel, please feel free to like and subscribe. In the meantime, if you are worried about your personal finances, the amount of tax you or your business is paying, or you're in a quandary around how you can scale your business by leveraging financing and accounting automation, please feel free to reach out to myself for a no obligation consultation. Otherwise, let's get back to the video.
Goldman Sachs, Bank of America, Barclays, JP Morgan Chase, and Deutsche Bank partnered with S&P Global to launch the CDX Financials Index, also known as Findex, which is the first credit default swap index explicitly linked to the private credit sector through exposure to business development companies. A credit default swap functions essentially as an insurance policy on the creditworthiness of a referenced entity. So where the buyer pays a periodic premium and receives a massive payout if that entity defaults or suffers a credit event.
That's exactly the product that was created in relation to The Big Short. And he's right that it's basically the same thing, because that's basically what he said. That's exactly what it is. So you're betting. So what happened with The Big Short is that the product I don't think actually existed. This type of insurance that he's describing, credit default swap, it didn't exist. And the individual involved, the guy that was played by Christian Bale, I can't remember the name of the actual trader, he actually went to a bank to create this product because he knew that there was going to be this massive crash. And as he says, it's like with any insurance product, you have to keep paying a premium in the event that one day you may then look to make a claim. That's essentially what's going on here, right? So what he's basically outlined here is that this insurance product covers you in the event that people default on their loan repayments, their private credit loan repayments. And if that is happening, then the likelihood of a payout increases. And that is how they're shorting or placing a short against this private credit bubble. They're using insurance products, essentially. And it's interesting, again, because you'd think the insurance provider, for want of a better word, that's selling this product, is anticipating the bubble won't burst, right? So that's what trading is. They're trading it, or they're betting against each other. The insurance provider is betting that more often than not, they won't have to pay out the insurance. And then the opposite is true of the insurance customer, for want of a better word, right? You don't necessarily get insurance because you're hoping for a payout, but you want it to be there if there is a need, right? But in this particular instance, the reason they're buying the product is specifically because they're anticipating to make a claim, for want of a better word.
The structural mirror is extraordinary because the ABX index that enabled the 2008 short was launched in January 2006 by Market, which is now part of the S&P Global, the exact same institution that has partnered with these banks to launch the new private credit equivalent. Wall Street does not invest millions of dollars constructing complex derivative infrastructure for sectors they consider healthy and well-functioning. They build these instruments when they have identified a credible, non-trivial probability of systemic deterioration.
Yeah, and this comes back to the video I covered with Professor Steve Keen, where he talked about the fact that, there's this concern he had, which I also share, where things like wars are opportunities to make trades. And again, this is a similar thing, right? We're anticipating a massive crash with respect to the private credit sector. And what traders are doing and what banks are doing is creating instruments and products that allow them to profit from price movements as a result of this. But I think, as I say, in my mind, to some degree, this is a clear example about, traders and economists. From their perspective, the impression I get is that this is just about being right. So it's not an ethical issue in terms of what is happening here. It's more around, am I right? And how can I benefit from being correct? And I think for me, that is ultimately how many investors and many traders see things, right? Many of us will invest in the hope that that investment is profitable, right? So I think for me, this is just another example of, this sort of indifference somewhat as to the wider consequences. And actually, as an individual, driven by, a capitalist mindset, how can I take what I know and profit from it?
And the evidence supporting the assessment is already visible across the entire institutional landscape. Fitch Ratings reported that the private credit default rate within their privately monitored portfolio reached 9.2% in 2025, a figure that surpasses the 6.5% peak recorded during the 2008 financial crisis itself. Meanwhile, Moody's has downgraded its outlook on the entire United States business development company sector from stable to negative, and Morgan Stanley analysts are projecting annual defaults could reach 8% between the second half of 2026 and the first half of 2027. The cracks in this facade are not theoretical projections sitting in analyst reports waiting to be validated, because the first quarter of 2026 produced the most concrete evidence that institutional investors are already running for the exits. Total individual investor withdrawal demands from major private credit firms exceeded $21 billion in a single quarter. Blue Owl Capital faced redemption requests of 21.9% of fund value and was forced to permanently halt all redemptions. The Carlyle Group's tactical private credit fund received requests to withdraw 15.7% of outstanding shares, but could only honor 5% on its core.
Yeah, so what he's talking about here is that a lot of these private equity and venture capital trusts are now having an increase in withdrawal requests from those that have invested in them, right? And what they're struggling to do is actually give them back their investment, essentially. They're struggling to do that because of the problems we've just described here around the fact they're not receiving enough from those that they've lended through private, they've lent to through private credit, and the increasing amount of defaults, i.e. the fact that they're not, they're missing payments, essentially. So this again is another signal that the sector is stressed, essentially, and therefore could potentially crash.
Managers must then choose between selling loan assets at severely distressed prices or imposing even tighter withdrawal restrictions.
Yeah, and I think what may be coming, what maybe you may be thinking watching this is that what has this got to do with me, right? Because as I mentioned before, typically private credit lending or investment tends to be those that are billionaires or high net worth individuals. That was historically where private credit and private equity was coming from, and therefore you would assume the risk is constrained to those individuals, and you are segregated from that risk. But what we're finding now actually is that because there's this increased demand for private credit lending, because the institutions and all institutions like banks are not able to do so because of more rigorous regulatory requirements, making it uneconomical for them to do so, pension funds have now stepped into this space. So if your pension fund or pension product, for example, is also, making private credit lending part of their pension portfolio, their asset portfolio, then the value of your pension is exposed to this risk. So this is why ultimately, again, I would have hoped regulation would have caught up, because if it's private individuals only and that risk is contained to them, then in some sense it is what it is. But then when other parties can start using retail investor money, i.e. pensioners or those building a pension, to then provide private credit lending, to me, that is where you would imagine, okay, where is the regulator to make sure everything is above board and the proper due diligence is being done? So this is how it impacts you, essentially, or one way this actually impacts you.
Asset sales at distressed prices cause the reported value of the fund to decline, further eroding the holdings of every remaining investor and accelerating the spiral of capital flight. The prominent economist Mohamed El-Erian has directly compared this freezing of private credit redemptions to the liquidity crisis that preceded the great financial crisis. You might assume that even if the private credit market experiences a severe dislocation, the damage would remain contained within those specific funds and their core.
Exactly what I'm saying. And this is why, again, you may be watching this and thinking, what the hell has this got to do with me? I'm not a billionaire. I'm not a high net worth individual. I am not lending privately. I'm not investing in any private credit funds or private equity funds, maybe. So what has this got to do with me? So let's hear what this guy has to say. But I think this is a really important point to try and reconcile why this actually is something you should be paying attention to.
That assumption, however, entirely ignores the deep interconnections between the shadow lending system and the regulated banking sector that the mainstream financial media continues to overlook. United States commercial bank loans to non-bank financial intermediaries, the category that includes private credit funds, reached $1.92 trillion as of March 2026, representing a 65.9% increase since the end of 2024.
Yeah, so the first thing he's saying there actually is that there's an indirect link between lending from actual banks to these non-regulated individuals or entities that are then extending loans to, or creating private credit loans, essentially. So that's the first thing, actually. There is this indirect connection to the banks.
Banks have lent nearly $300 billion directly to private credit providers as back leverage, meaning the regulated bank system is financing the very shadow lending operations that exist outside its regulatory parameter. This creates the classic macroeconomic transmission channel where distress in the unregulated sector flows directly back into the balance sheets of those institutions that the Federal Reserve is mandated to protect.
Yeah, and it's very interesting, actually, because again, it kind of reminds me of the collateral debt obligation product, actually, where you had what you would call AAA mortgage products, which would be mortgages extended to those that were actually in a position to repay. And then they were taking those same mortgage products and mixing them in with mortgages that were extended to people without jobs, without any assets, and no track record of repaying their debt, essentially. So this to me feels very, very similar, whereby you're taking a banking product, which i.e. they've basically extended financing to a private equity fund, let's say, and then they're essentially reselling that product in the form of private credit, potentially, with an improved margin. So the original financing product might be at like 3%. And then they're creating off the back of that this private credit product, which might be at 5%, to then use to, for example, get a leveraged buyout of a business. So it all starts getting all mixed up and very, very messy. But the moment, and it's almost like it's built on a house of cards, essentially, is what I'm saying. So the moment the default rates start increasing, i.e. the business is struggling to start repaying the interest payments and the principal of the private credit loan, it flows all the way back up to the institutional banks by virtue of this arrangement. And the whole house of cards falls down. Hence the bets against the private credit market and these credit swap instruments that have been created for this very purpose.
Private credit fund collateral values are marked down. The banks that lend against that collateral face rising credit risk on their own books and respond by tightening lending standards across the entire economy. And for holders of Bitcoin and risk assets, the contagion pathway is devastatingly direct. Institutional investors, including pension funds, insurance companies, and endowments, now hold private credit alongside equities and digital assets within.
And that's exactly what I was saying before. So there is an exposure with respect to pension funds as well. So if you have a pension, you are exposed.
The same portfolio allocation frameworks. 94% of institutional investors currently allocate to private credit, and global institutional allocations to private markets reached a record 12.5% of total portfolios in 2025. So when these institutions face losses in their illiquid private credit holdings, they cannot sell the loans, so they are forced to liquidate whatever assets they can sell to meet margin calls and redemption demands. That means public equities, treasury bonds, and increasingly Bitcoin and other digital assets available through spot exchange traded funds.
And another thing to bear in mind here with respect to this credit swap product is that it becomes more valuable as default rates increase, right? Because there's going to be this panic to sell the underlying private credit product to get rid of it, right? Because it's just losing value all the time. And therefore that selling depresses the value even further, and therefore makes the credit swap insurance product even more valuable. And therefore those that have made this bet are making even more and more money. And that's again essentially what happened with the financial crash in 2008 and the big short.
the identical forced selling dynamic that produced the 50% crash in Bitcoin during the March 2020 liquidity crisis, when institutional investors liquidated everything regardless of fundamental conviction simply because they needed cash.
Yeah, so what he's saying here is that where you run out of cash through operations, or you're struggling to allow investors in your private equity fund to withdraw, so this is redeem their investment, and you're limiting that, then any other holdings you have as part of your portfolio, you may have to liquidate or sell in order to cover those withdrawal or redemption requests, or cover your interest payments if you're the business. And one of those assets might be Bitcoin. And if Bitcoin is being sold, you know, in order to do this, it increases supply relative to demand, and therefore depresses the value of Bitcoin. So that's essentially what he's describing here. So again, if you hold Bitcoin and this problem is big enough, then it may impact your Bitcoin holding if you're thinking about selling Bitcoin in the near future. If you're not, then in some ways it's an unrealized loss. But if you are looking to sell as part of your financial planning, depending on the timing, this could really hurt you. Or if you're a trader on Bitcoin, speculating on the price of Bitcoin, for example, again, depending on your risk management process and the timing, it could also hurt you.
The disruption to the safe haven narrative would be temporary, because the historical pattern demonstrates that every systemic deleveraging event of this magnitude ultimately forces the Federal Reserve's hand. The central bank has already demonstrated its willingness to intervene, having cut rates by 150 basis points between September and December of 2024 in response to leveraged borrower distress. The Fed has also deployed targeted liquidity injections through its standing repo facility, including a $74.6 billion operation in early January 2000.
Yeah, and this feels very much like the quantitative easing that happened in 2008, and the lowering of interest rates to mitigate the damage, right? It all feels very familiar. It's like history is repeating himself, as he said from the outset of the video. So it's quite interesting in that regard.
That some analysts have characterized as disguised quantitative easing.
Yes, and that's exactly what I was saying. It feels like quantitative easing. If it smells like a duck, looks like a duck, sounds like a duck.
To the shadow landing system, the Federal Reserve cannot simply allow a private credit collapse to transmit into the regulated banking sector without mounting an emergency response. And that emergency response, whether through aggressive rate cuts, balance sheet expansions, or formal quantitative easing, would represent the exact type of fiat liquidity injection that has historically ignited the most powerful subsequent rallies in Bitcoin and risk assets.
Yeah, and the reason why he's saying it's then prompted these massive rallies in asset price, and he's showing Bitcoin here in this graph, is exactly what Gary Stevenson talked about with respect to the pandemic, right? So what Gary Stevenson always talks about is the fact that economics ignores wealth inequality. And part of that means that when this modeling is being done, and there's a massive injection of cash into the system for various reasons, whether it be to enable, lending to happen again with respect to, this illiquidity we're observing with respect to the financial crash in 2008, and potentially with respect to this private credit bubble that's appearing and may burst. And more specifically with respect to Gary Stevenson, he was talking about what happened when furloughing was happening and business were being supported through basically cash payments. Those that needed the money, in this case, businesses that needed the money or need the money to cover their interest payments, will use it for that purpose. But everybody else who may just see a gain where they don't need it, let's say, what they're going to do is take that money and buy more assets. And that's essentially what he's saying here. If the bank is essentially printing money, quantitative easing, and there's more money in circulation, and it gets into the hands of those that don't necessarily need it, as well as those that do need it, those that don't need it will just buy more assets, and those assets will be distressed because of what's happening, right? Bitcoin may be down because people are selling it off to cover their obligations. Businesses may be failing, struggling to pay back their interest payments, and therefore their valuations are lower and they'll be more motivated to sell. So those that are in a position to buy under those conditions are winning, essentially. So I think that's essentially what he's alluding to here.
The creation of a centralized shorting mechanism for private credit confirms that the most sophisticated financial institutions on Wall Street are actively positioning for a systemic wave of corporate defaults. We have constructed a hyper-leveraged shadow banking ecosystem that grew from $40 billion to $3 trillion on the assumption that interest rates would remain near zero permanently, an assumption that the Federal Reserve shattered and has shown absolutely no urgency to restore.
Yeah, and I think what's interesting about this is that, we're talking about this, like it's a potential certainty, and it may not be a certainty, right? So any trading is risky, and I do want to be clear about this. Although this is hanging together and a narrative is forming, and it does feel very, there is a feeling of deja vu here. When it comes to trading, the past doesn't necessarily tell us what's going to happen in the future, per se. So I would bear this in mind if you're thinking about how this may affect you and your trading decisions. It's really important you do your own research. All we can understand here is that there is a growing feeling, according to this individual here, that there is a risk to the private credit sector, and either to hedge or to make a massive gain, we are now finding that there's more and more investment into products that help you or bets that help you gain from an expected or potential crash. But again, there is risk involved, and if it doesn't happen, those that have made that trade will make a lot, they will make huge losses, essentially. So nothing is risk-free, is essentially what I'm saying. And please do bear that in mind when considering what is being discussed here.
The floating rate arithmetic becomes too brutal for these borrowers to survive, and the evidence overwhelmingly suggests that threshold has already been breached. The illusion of a private market stability will fracture in a way that forces institutional capital to flee from every asset class simultaneously. While the financial media celebrates resilient equity markets, the institutions behind the headlines are already purchasing fire insurance on the foundations of the underlying economy.
Yeah, so really interesting video. I think there was a lot to take in there, and it did get quite technical with some of the things he was discussing. But I think for me, the best way to think about topics like this is to try and keep it as very simple in your mind as possible. And I've done my best to try and explain things where I can. But again, if it's something that is still unclear and you do want to discuss it further, as I say, please feel free to use my contact details in the description to reach out, or put something in the comments and we can have a conversation there. But essentially what he's describing here in a broad sense is that as a result of the crash, one of the lessons potentially that was learned was that lending should be more regulated and potentially more restricted based on stricter affordability criteria and stricter Basel requirements. So we refer to Basel 3. And one of the features of Basel 3, or one of the things it talks about, is how much money an institution must have in order to lend. And what has happened because of these changes is that banks have felt, for whatever reason, that smaller to medium-sized businesses are not as profitable to lend to as they had been, and they've removed those lending products. And as a result, these businesses have sought alternative forms of lending. And what has blown up as a result of that is private credit lending, which has always existed and has always been restricted historically to high net worth individuals or a group of high net worth individuals, but has now extended itself through to pension funds and also the banks who are lending indirectly and getting exposure indirectly to a market which they've had to step away from, right? So they've not fully stepped away from this market because of regulation. They're just doing it indirectly through these private equity funds, essentially. But as a result of this lack of regulation in this private credit space, and the fact that there's this conflict with respect to potential buyouts where they're trying to prop up the business and show it as being more valuable as it is for the purposes of asset management fees, for example, and favorable private credit terms, essentially the level of defaults, i.e. businesses failing to pay back interest rates and the principal of these private credit loans, is much higher than we observed at the time preceding the financial crash in 2008. And therefore, many traders and institutions are positioning themselves to gain from this potential crash. And therefore, and as I say, the wider implication of this crash is an exposure to banks and also those with pensions. So I think for me, this is a really interesting video. And it's really something, I'll be thinking about more separately. And I think for me, it kind of reinforces in my own mind the importance of proactive regulation. And for me, that is the biggest question I've got in my mind here, actually, in terms of what has been described and what we're observing. Where is the regulation? This has been happening for the last 15 years in terms of the growth of this sector. There was time in my mind for this regulation to catch up with it. And maybe there is regulation around it, but it's not the impression I'm getting because the risk is still there. And it doesn't feel as though it's being addressed. And rather that actually we're finding that, traders are bullish enough to make these bets that it's going to crash, which again would imply that they're not anticipating any regulation to step in and protect consumers, for example, or retail investors. So yeah, really, really interesting video. Let me know what you thought. Hopefully you found that useful. But until next time, peace.